So I get a lot of homeowners asking me what to look for, what not to look for on a home policy. And quite frankly, the things you really want to pay attention to are really, it boils down to three things. One is, what do they have your dwelling replacement cost at? So what that means to you basically is that in insurance, we don't look at market value, we don't look at appraisal value, we look at cost. So, what is it going to cost Bob to rebuild his house should it burn down to the ground? So, doesn't matter location. You could put Bob's house on the beach. It's going to be worth $1 million. If you put Bob's house on a backcountry road, it's going to be worth $100,000. So, but the cost to rebuild it is going to be pretty close to the same because it's going to be the same size of a home, same square footage, same finished materials. So we only look at cost. Number two, you want to make sure that it has a replacement cost calculated as your lost settlement. If it has actual cash value, you're not going to get the same level of coverage that you would having replacement cost loss settlement. So make sure that you do have that the dwelling is set at replacement cost. You also want to make sure the contents, your personal property, take the home, turn it upside down, shake it loose. Anything shakes loose is personal property. You want that also to be at replacement cost, because if it is at actual cash value, it will include depreciation, meaning that they will depreciate your stuff and give you what market rate is on a used couch. That is not what you're going to need if your house burns down and you're left with nothing but the shirt on your back. You're going to need to go out and buy new stuff, and you're going to need to do so very quickly. And so having replacement costs on your contents also is very important. So those are two things right there off the bat. Number three, I get asked all the time, what is a right deductible for me? The honest and best way that I tell you to gauge what type or what amount of a deductible to choose from is, don't go with a deductible larger than you're financially able to swallow. Meaning, if you go with a $2,500 deductible, you close on the house, you just spend a lot of money on closing costs, moving in, those sort of things. And you, quite frankly, pray this don't happen, but it has happened many times. Then you have a water line that burst 3 weeks after you move in, and you got a $2,500 deductible, but you've just emptied all of your emergency reserves, or most of it. Uncle Murphy has a weird way of showing up in those particular times. So what I would suggest is, especially for first-time homebuyers, if you don't have a huge rainy day fund, then go with a lower deductible. Yes, that means your monthly payment is going to be more, but you will have the peace of mind and security to know if something happens, then your max out of pocket is only going to be $500 or $1,000. Then as you gradually build that nest egg and emergency reserves back up, then you're going to want, then you can, increase the deductible if you so choose. But, buying a home, we can get into the whole side conversation about should you buy a home if you have little to no money in the bank anyway. Side note, answer, no. You should have your rainy day fund 3 months at least, and then any overages beyond that, you really could put towards a down payment on a house. But owning a house can be turn the American dream into an American nightmare if you are not financially stable enough to take a punch from life if it throws it. because genuinely it will. So that's all for today. Continue to watch the videos, rewind, repeat for more knowledge, more training, more insight. And of course, repetition is the mother of all learning. So there's a lot of data, a lot of information thrown at you in just a few minutes. So press repeat. Look for me on the next video.